Welcome to the What to Watch video update. Every week I do a number of different videos. Well, the last video that I do over the weekend is I pick out those charts that are really saying something right now. And the list is pretty long this week, and it's even rather positive this week. And I take those charts and I have a positive section and then a negative section because things are never completely black and white when it comes to the stock market. We might be looking better in one area, but there's other areas that we want to keep an eye on that are causing a little bit of concern. And then taking all of that together helps us to form the consensus approach, which is how I implement technical analysis. I don't just look at a few indicators. I know that I get criticized sometimes for having analysis paralysis, but I look at everything together. I have some charts that are more important than others that I really look at and focus on, and then a lot of secondary charts as well. And then together, I reach what I call the consensus approach with how things are looking for the S&P 500. This is being prepared for Monday, August 19th. Before I get into that, I do have a program. Now, you get early access to all the videos that I upload if you're a member of the program. So if you like to have these a little bit earlier, especially the daily video, which is the foundation of the analysis that I do, you'll want to be a member of this program. For right now, it's still free. If you want to learn more about it, there is a link in the description that will take you to the website as well as to a playlist of videos that you can learn more about the program. As I did mention, I do a lot of videos each week. What I'm finishing now is the outside circle here, which are the weekly videos, but they all tie into the daily video. This is where we can see things as they're developing. We can develop foresight, anticipate things before they actually end up happening. Or sometimes the weekly videos, we're too late by the time we actually see things in that way. So if you really want a step-by-step analysis and commentary, please tune into the daily videos. First of all, I'll go through and look at the positive things. And yes, this is pretty long this week. The first chart that I want to show you, this is what I watch during the day. Depending on what charts are really speaking, I watch a number of different charts, but this is one I always watch. This is a 10-minute intraday chart of the S&P 500. And the reason why it's a little bit longer, if you've seen me post these charts before, is I wanted to go all the way back to the bottom that we set on August 5th. This was the big decline when everybody was talking about the VIX and you had all these people screaming for an emergency rate cut from the Fed and all this stuff was happening. Well, we saw that building up before it actually happened. And then we were able to establish a pretty solid base. We came down to this S3 level, and then we came down and tested it again. That was also lining up with some support levels that we were seeing on daily charts and even on some weekly charts. And then from there, we started to come up. Now, Wednesday of that same week, we did see a pretty severe decline, but we were able to gap higher. And pretty much since then, we've been just going higher all the way up until Friday's close. And this has been a nice little rebound. You typically may see this on a daily chart. Well, this gives you an intraday look at how things are acting. Also, our trend has switched from negative to positive. This is the ADX. This is my primary indicator, probably the one that I rely on the most for helping us in a number of different ways. We follow the black line, that's the ADX itself. When this is going up, that means it's a strengthening trend. When this is going down, that means the trend is weakening. And we get additional information from that by saying, okay, there's a red line and a green line. Which one's on top? Well, we've seen the green line cross above the red line, so now we've crossed over positive. Also, when we're above 20, which is a static number, now you may use a different number if you use the ADX on stocks or other indexes, but I have found 20 to work quite well with the S&P 500. The concern that we do have here is that the ADX is coming down. That suggests a weakening trend. But since we're above the static level of 20, we're still in a trending environment. And some of this could be because the red line was coming down and the green line was going up. The ADX is like, wait a minute, what's going on here? And if we continue to see the green line going up, we will probably see the ADX turn up and then eventually get to the point where it crosses above its moving average. And that would suggest a strengthening trend. Here's a daily chart. We haven't been showing this in this video for a while. There's a number of different things we can point out here. We came just about down to this pivot point. Even though it's a little bit past, this did end up providing some pretty good support, and we bounced up off of that. A really positive thing that happened is we were able to close slightly above the 50-day moving average, and then we were able to go above that as well and get above this pivot point. So we're seeing much improvement here as we've been going back up. We've been filling in the gaps that we saw as prices were going down. We don't know if we'll go back and set a new all-time high. There is some overhead resistance here just about at the previous all-time high. But for right now, this is looking much improved. We have the blue line above the red line. That means we're in an uptrend. So this is looking better. Now there's a warning sign on this. This is a daily chart. And notice when we were coming down, you look at the bottom, volume was way above average. Well, now that we're going back up, volume is below average. And this is a classic negative divergence. Now we have to ultimately follow price. That's the most important thing. But by looking at volume, that can tell us the intensity or velocity or conviction that's behind a certain move. And it's a little bit concerning to us to have us going back up on a decrease in volume. Plus, Friday was options expiration. These big spikes that you see here, these are typically other options expiration times. We didn't even get above average on Friday. So that's just a little strange. Not necessarily positive or negative, just not typical of what we see. We also are following sentiment, and we've been watching this. I watch it every day, but we've been watching it as we drop down below 25. We tend to go with this. So as this was dropping, this was confirming the other negative charts that we were seeing, and we were able to take advantage of the bearish move down and make some really nice profits on a few positions. Well, once we get down to 25 or below, that means that maybe we're getting a little too pessimistic about things. And that's the point when we look at using this as a contrarian indicator. And since that time, we've been bouncing up. Now we're turning positive, but we're not positive yet. We won't actually be positive until we get back above 50, but we are going up, and we tend to go with that. We're seeing sentiment really, really improve over the last couple of weeks, ever since we saw that big decline. So for right now, this is positive. The VIX. This is what people were talking about, even though they probably never heard of it before. On the big down day, we spiked up and got up to about 65 on the VIX. Well, since that time, we've just been marching our way back down. The line chart that you see here, these are just closing values for the VIX, and we're coming down back into an area closer to what we've spent most of our time in 2024. The lower chart is a bar chart, so it has the open, high, low, close. This shows the spike up and then the drop as we've been coming back down and actually going underneath the moving averages here. So as this is going down, that's more positive for stocks because that means fear is going away. This is the VIX of the VIX, which measures how fast the VIX is moving. When we were really going up, the VIX of the VIX was also going up. And now that we're coming back down, the VIX of the VIX is also going lower based on the bar chart as well as the line chart. Then we look at another way of measuring the momentum. Is it going up or is it going down? The VIX had really been going up. And you can see before the big spike up, we were already seeing upward momentum with the VIX. Then we spiked, came back down, and now we're falling. And so the momentum for the VIX has now rolled over and become negative based on the MACD momentum oscillator that we use, or indicator that we use. Then we also look at a ratio. VIX measures the volatility of the S&P 500. The MOVE index measures the volatility of bonds. And as both were going down and a lot of fear was coming into the market, we were really spiking up. Now this is starting to come back down. As a general rule, when this is declining, that is more positive for stocks. And here's another look. Here's the MOVE index all by itself. As interest rates have been going down, the MOVE index has also been going down. Well, the VIX spiked up and it's also been going down. And what I pay attention to the most is on the bottom, the correlation between the two. Now, this is not measuring direction. This is measuring volatility based on looking at stocks versus bonds. And they have a pretty high correlated relationship. So they're tending to either go up or down together, whether volatility is increasing or decreasing. This is a study put out by Tom Bowley, who is connected with stockcharts.com. He also has another site called earningsbeats.com. And he did this in late 2023 with the numbers that you see here. But this chart is actually updated as of Friday's close, where we just went through the roof here with the VIX. Now, this is a weekly chart of the VIX. And then we came back down and we're getting into this area where we're seeing more positive annualized returns. We haven't come all the way down below 13 yet, but we have dropped below 15. We're at 14.8 right now. That's a lot different than up here at 65. If we can continue to go up with stocks, the VIX will continue to drop, and that's when we see the best annualized returns. Then here's another intraday chart. Now, some growth in value is not looking all that great, but this growth in value chart with the S&P is showing some improvement. Not so much what happened on Friday, but this is what we saw going into the big decline, the first part of August, and then boom, here is the big decline that we saw August 5th on that Monday. And then we came back down, set up a bit of a support level here. And then since that time, this is what I wanted to stress. Even though this is an intraday chart, you can see how we've been going up here. Doesn't go straight up. Some days we have down days with this ratio, but overall, this is showing a lot of improvement. Then we look at the closing values of a couple of ETFs, a growth ETF and a value ETF, and this was showing a lot of weakness. Excuse me. We did drop slightly below the 250 period moving average, and we thought, uh-oh, maybe we didn't hold on to support here. Because when we came down in April, we came down to this 250 period moving average and then bounced up off of that. We actually overshot it a little bit to the downside. But since that time, we're seeing some improvement here. We're still inside the rainbow. So this hasn't turned full-blown positive, but this is starting to show some improvement when we look at this ratio between growth and value. We want to keep an eye on initial jobless claims and continuing claims, and then the unemployment rate. Now, we're not going to get any more information until Thursday this week, and we won't get a new unemployment rate until the beginning of September. But the market's really focused on this. This is what started to shift things in early August, was when we had the weak employment situation report. That's the whole month. Well, every week we get jobless claims and continuing claims, and those are a little bit closer to right now, so we can follow those along. And they ended up coming in weaker than expected in the latest reading. Now, I have a couple of different charts here where I put moving averages on here. These are just the raw numbers. The red line that you see here, these are initial claims. These are people filing for unemployment for the first time. This is declining, and the market really liked that because they were afraid, uh-oh, based on the employment situation report, the economy could be falling off a cliff, and this should really be spiking up. Well, the fact that it's coming down is actually positive for the market, and the market liked that. And then we look at continuing claims, those people that go on being unemployed for 1 week. This is rolling over a little bit. And I also have a separate chart that I show in the daily video where I have a moving average on here, but this is not shooting up either. The one thing that kind of freaked out the market when the employment situation report came out, that's when we had the unemployment rate, and it's up to 4.3 now. Still very low historically, but it's been going up over time in 2023 into 2024, and the market is starting to get a little spooked over this, and that's what caused some of the problems. So we watch these numbers when they come out every Thursday just to see how well they're behaving. Right now, they're looking pretty good, and that they're not showing a lot of weakness in the employment area. And we look at a risk on to risk off ratio. Risk on is when folks want to get into high beta stocks. This would be like Nvidia, Google, Apple. They tend to outperform the market when we're going up. Unfortunately, they outperform the market when we're going down, meaning they go down faster. And so that's when people go risk off. They want to be out of those stocks because they're losing money quicker than the rest of the market. And then when they're in more of a risk off posture, then they want to get into the S&P 500 equal weight. There's more value in here. There's more conservative stocks. And it doesn't mean those stocks won't go down. It just means they may go down less than the high beta stocks. And so when this ratio is going up, that usually means the market is really strong at that time. Well, we've been pretty much range bound here for most of 2024 until we saw some weakness developing in early August. We really started to shoot down with this. And so that means the market was assuming a risk off type of stance. Well, now we've been bouncing back up. Even though we were down a little bit on Friday, we're seeing this starting to bounce back up as well as folks are willing to get more risk on right now. Now, another way that you can look at risk on, risk off is risk on means stocks, risk off typically means bonds. But we're not looking at it this way. We're looking at more powerful stocks, risk on, more conservative stocks, risk off. And if this can continue to go up, that would be more positive for the stock market. Large cap growth. This is where we just look at the big stocks right here. We came almost down to the 200-day moving average, and then we were able to bounce up off of that. We got above the 100 period moving average, and now we were able to get above the 50. So this is showing a lot of improvement here. If this can continue to go up, we saw the decline happen rather quickly. And so we didn't see any of these moving averages cross over each other, but there was still a lot of damage done, but it didn't last all that long. And if we can continue to go up, this chart will just continue to show more improvement. We look at the large caps, which typically they play the leadership role when the market's going up. Now, there are times when small caps do quite well, but we take a ratio between them just to see how they're behaving with each other. And we had been really seeing the small caps starting to outperform, or excuse me, the large caps were outperforming. And then everybody seemed to fall in love, at least for a few days, kind of a short-term relationship with the small caps. And then we saw this ratio just really fall into the decline that we saw. Well, this is starting to go back up, even though it declined a little bit on Friday. The fact that this is going up, it's usually the large caps that will help lead the market higher. And then we have, of course, the Magnificent Seven and the Great Eight, the Illustrious 11, all the really big companies that really drive the indexes higher or lower. To be more positive, we want to see this ratio continue to go up. Now, we look internally at the S&P. We look at the advanced decline line, and we're seeing some positive and negative things on this chart. We're positive in that we're breaking out to new all-time highs with the advanced decline line based on price. We're also really improving here based on volume. But you notice we're breaking out with price. We're not breaking out yet based on volume. We saw more downward pressure with volume as price was going down, and that was a concern and something that I was trying to point out in the videos. Now that we're going back up, volume has a bit more work to do here to repair itself. And if we can see a breakout above these previous highs with volume, that would give us more confidence that things are actually looking better. Another positive aspect of this chart is with both price and volume, we continue to be above the moving average, and the moving average is sloping higher. So that tends to do well for the market also. Another internal measure, new highs versus new lows. Not really seeing a breakout of the new highs. They are dropping off a little bit here, but we're not seeing any kind of an expansion of the new lows either. So overall, we're seeing a lot more green than we are red. Enough to start to turn our 5-period moving average up, but we're still declining with the 10-period. But for right now, this is still positive when we see more green than red with our raw scores. An advanced decline ratio, both based on 19 periods and 39 periods. This is more short term, and the 39 is more intermediate term. We're above zero in advancing. That is positive. And this is a further breakout. The previous chart just showed, based on price, the 19-day advanced decline ratio, and we're above zero, excuse me, and going up. With volume, we're also crossing back above zero and going up, where we were seeing a bit of a negative divergence between price and volume for a while. Now they are confirming each other. Then this is another smart money indicator, and one of the primary indicators that I look at. Accumulation distribution. It not only measures direction, whether we're going up or down, it also takes volume into account. So we can see what is the smart money actually doing, the really big, influential institutions and so forth. Well, we had been negative. We were below a declining moving average. We were able to cross back above that. And so this is going from negative back over to positive. Now, what I have down below is called the boom indicator. This measures how far away do we get from this moving average. It's not a true representation. I have to take a MACD and just kind of manipulate it a bit to assimilate what we're seeing in reference to the moving average here. Because down here, it's already suggesting that we're extreme. Well, you can see just by looking at this, we have been farther away from this before we get to an extreme reading. So we'll be looking for this to back off a little bit. We still want to pay attention to this because we might be going up a little too far too fast. But at the same time, the longer we can stay above the red line, which is the moving average, the more positive this will be. And this now is looking positive as one of our primary indicators. Another one is the Chaikin money flow, a smart money indicator. Has not turned positive yet, but after getting an extreme negative reading here, we started to turn, and then I have a moving average plotted on here that is starting to go up. So it's not full-blown positive, but we're treating this as positive now since it is really improving. We're just a little below the zero line. If we have another up day, this is probably going to switch over and go positive. Chaikin oscillator has been positive and was even continuing to go up as prices were going down. So this was giving us a bit of a heads up. We crossed above the midpoint and we're continuing to go up, and we're not necessarily extreme right now. So this is full-blown positive. Now, what we do is we take the accumulation distribution, the Chaikin money flow, and the Chaikin oscillator, and we put them together as our smart money indicators, and all three are looking positive at this time. We look at the vortex, another primary indicator, very simple to implement. The green line has crossed back above the red line. That's positive. When the red line's on top, that's negative. Excuse me. But we are turning over positive here, and so we're seeing another primary indicator that has switched over to positive. We want to keep an eye on the moving averages. We have a 20 period, 50 period, and 200 period moving average of the S&P itself. This is just measuring the price of the S&P. It's not looking internally at the S&P 500. We are going up. We're just a little bit below this blue line here with the 20 period. If we continue to go up, we will be extreme positive with this moving average. We're going up with the 50. We were pretty much flat on Friday, but we are starting to go back up overall with the 200 period moving average. Then we go inside of the S&P 500 and we look at those stocks in the S&P that are above their 20 period moving averages. We're above 50 and going up. That's positive. Now, attached to that is this study. Just to give you an idea, back in April, we really saw an extreme negative reading. And then not long after that, we saw a thrust up where we went above 70. That's showing really good strength. And then you can see what the S&P did after that. It really had a nice run. Even with the decline that we saw, we didn't get down to an extreme negative reading. But we have been going up here and we're above 70, which is also suggesting good, solid upward movement at this time. Then we look at those stocks above their 50 period moving average, above 50 and going up. That is turning more positive. And then the 100 period moving average above 50 and going up. That's positive. And we flattened out a little bit, but we are above 50 with the 200 period moving average study. And overall, we're continuing to go back up. Then there's the boom indicator that I implement, how I've done it for many, many years here. This is how far away are we from various moving averages. There's a 20 period, a 50 period, and a 200. We're looking quite positive here with our distance away from the 20 period moving average. In fact, maybe a little too positive. When we go above this blue line, that means that we're getting kind of far away. And a moving average tends to act like a magnet, or if price goes away, it's like a rubber band. It has a tendency to snap back to the moving average. We had been extreme negative just a week and a half ago. Now we're looking rather extreme positive. To see this move from such an extreme negative reading when we saw the decline to an extreme positive reading, that could suggest good solid momentum with the 20 period moving average that we're using as the base. We did get extreme negative on our distance away from the 50 period moving average, and now we're coming back up, crossing above zero. So we're turning positive here. We never went negative with our distance away from the 200 period moving average, but we are showing some improvement. So this might be a little too positive for right now, but with the intermediate and long term, we are showing an improvement here. This is the condition of our 20 period moving average trend. Now, this is a little bit different way that these are calculated. This is a double and a triple exponential moving average based on 20 periods. We were looking rather negative. We were going down. We saw the lines going down, and this was not looking all that good in the short term. Well, we finally hit bottom. We've been coming back up. We're breaking above both of the lines, and now the lines themselves are starting to turn up. So this is showing a lot of improvement. And then this is a regular 20 period moving average study. And I plot both a simple, where you treat all 20 periods the same, versus an exponential, where it's more weighted to current prices. And this is looking a lot better. When we're above this moving average, we are positive. When we're below it, we are negative. Now, another thing that's happening that's looking more positive, if you see the blue line here, that's the exponential moving average, and it moves faster than the simple moving average. It's starting to cross back above the red line. And so that's turning the short-term trend more positive. Then here's another 20 period moving average study. We take the open, high, low, close and do a 20 period moving average study of those. Now, the way I use this is when we're going up and we fall back, usually or quite often, if the short-term trend still stays intact, one of these lines may act as support. Well, we started to come down. We fell below this little mini rainbow here. We came back up and it actually acted as resistance. And then we fell well below the rainbow and the rainbow started to roll over. Well, now we were coming back up and we spent a day or two trying to fight our way through this little mini rainbow. But now we've been able to break above it. And this is showing a lot of improvement. The longer we can stay above the mini rainbow, the more these lines will turn up and help things look more positive. Then here's the similar type of thing here with the double and triple exponential moving averages, but this is based on 50 periods. So this is intermediate term where we had fallen below both the red line and the blue line, and we're looking quite negative here. And you can see the gaps that we saw on the way down. Well, we've seen more of a systematic rise as we're going up. There's a bit of a gap from Wednesday to Thursday here, but the lines are starting to turn back up. Now, it would be even more positive if the red line would cross above the blue line because it moves quicker. So if we can continue to go up, this will also help the intermediate term trend to improve. And here's a regular 50 period moving average study, a simple and exponential. We're breaking out above both of the lines. We're able to get back above those. It would be even more positive if we could stay above this and then have the blue line come above the red line. Here's all the moving averages together, just simple and exponential moving averages. And we're above all of these. Again, the longer we can stay above this, the 20s, which drop down below the 50s, they will eventually turn and go back up and cross above the 50s. If that happens, that will smooth these lines out and make the trend look more sustained here like we were seeing earlier in the year. That would turn things much more positive. Then I don't usually show this in any other video other than the deep dive video. This is another weekly video that I do. But this is a short-term rainbow, and people think, ooh, it looks kind of cool with all the different colors, ooh, ah. Well, I like to have this going back a considerable amount of time to get a bigger picture look. And when we were going up and in a good solid environment, we want to be above all the lines in the rainbow. Well, then we started to see some problems. We came down into the rainbow, sliced through the rainbow, and fell below it. And that was causing these lines to get all crazy here and start to jumble up. Well, we've been able to break back above all the lines in this rainbow. And if we do keep going up, the lines will turn back up, they'll smooth out, and they may look like they were looking earlier in 2024 if we continue to go up. Here's an intermediate term rainbow going from 50 periods up to 100 periods. Now, the decline that we saw happened pretty quick, so we didn't really see these lines. They jumbled up a little with each other, but it's not looking like spaghetti necessarily. We were able to break back above the rainbow right now, so not an awful lot of damage was done to the intermediate term, even though we were negative there and quite negative for some time before we switched back over to positive. In the long term, we just came down into the rainbow and then bounced up out of the rainbow without really moving these lines around. These are moving averages that go from 50 periods up to 250 periods. The McClellan oscillator. This is a momentum oscillator that we use. We're above zero and going up and not necessarily extreme positive. This is positive in and of itself, where we had been negative and we almost got to an extreme negative reading when we saw the big decline. So when the McClellan oscillator is positive, that means the summation index based on price is positive. We're turning and going up based on price and volume. Now, one thing that was a real concern before we saw the decline into August 5th is that we were going up based on price, but we were going down based on volume. And that was a negative divergence that was causing us some concern. Now we're seeing them move in the same direction at the same time. Now you can look at this and look at these longer term negative divergences and so forth. That's one thing that we do keep an eye on. But for right now, the fact that they're both going up, and this is actually crossed back above zero with the volume parts, and going up based on price is looking rather positive at this time. Swenlin trading oscillator, not really a primary indicator, but it's kind of right in between a primary and secondary indicator. This is one I put a lot of importance in. And sometimes this gives us just awesome signals, but other times it has led us astray as well. No indicator works perfectly. That's another reason for looking at a lot of different indicators to reach a consensus as to what's happening. Where we're above zero and advancing based on price and volume, these are confirming each other and looking more positive for the time being. We're trying to look better here with momentum. This is the price momentum oscillator, turning back up, crossing above its moving average after it had dropped below the midpoint. This was turning quite negative. Now we break this out based on price, turning back above the moving average, and we were declining with even more velocity based on volume. Now this is starting to turn back up as well. So we're seeing confirmation when we look at all three of these charts together. And based on that, we look at the S&P 500 and do some PMO studies on that. And we see that the PMOs in the S&P 500 are going up, we're seeing the buy signals going up, and we're seeing the PMOs that are above zero starting to go up. So this chart is showing a lot of improvement, actually turning over to positive. Then the parabolic SAR, this is another primary indicator. When we were really humming to the downside, the parabolic SAR was negative. We finally saw enough of an upward move where we saw dots coming underneath. That switched from negative to positive. And so this is either positive or negative. It's either one way or the other. There's no in between with this particular chart. Then we look at the slope oscillator. This is our shortest term oscillator that we look at. It had come down, was looking really negative, but then we started to turn up and come above the moving average. It's not full-blown negative yet until we cross above zero, positive, until we go back above zero. But we are above the moving average and we're going up, so we're treating this as positive. MACD, this is more short to intermediate term, crossing above its moving average, going back up, but not quite above zero yet. So we have a whole list here of oscillators. I have two short-term oscillators that are looking much better. We're seeing a lot of improvement with the three intermediate-term oscillators that I post here. And with our long-term oscillators, the Trix and KST, we're turning up and we're getting a little close here with the KST, but we're not quite above the moving averages yet with these long-term oscillators. And then the bullish percent index. I like this indicator because it's not moving average based, it's point and figure based. Inside the S&P, if point and figure buy signals are being triggered, this indicator goes up. If sell signals are being triggered, this indicator goes down. And we're above 50 and going up and not necessarily extreme. Now, the good thing about this is we were seeing some divergences here as the S&P was going up. This was really lagging behind and not really participating in things. That just means that it was a few stocks that were driving the S&P higher, the real big mega caps. All right. And then initially when we started to decline, the BPI held up better, but then it fell down with everything else. The fact that this is going up as the S&P is going up just suggests that the stocks across the S&P 500 are participating in this up move, and that is more positive. Then we look at the NYSE bullish percent index. This had actually given us a very positive reading here, positive across the whole market, best looking chart. But then we fell back down. We actually went negative when we dropped below 50. We've come back above 50 and we're showing some improvement here as well. So this is looking more positive, and it actually is positive since we're above 50. And also keep an eye on the NASDAQ 100 bullish percent index. It was really screaming to the downside, almost to a extreme negative reading. Well, since then, it's been bouncing back up, crossing back above 50, even though it was flat on Friday. This is looking much more positive. So you take all these bullish percent indexes together, and they're looking pretty good right now with the S&P, the NASDAQ 100, and the NYSE. So the NASDAQ 100 is probably since it's only 100 stocks, and then we get the NYSE, which is lots and lots of stocks. And then right in the middle is the S&P 500 with 503 stocks. We look at the cumulative advanced decline line for the S&P based on price, breaking out to new highs here. That's quite positive. We're also really improving here based on volume, but we haven't broken out above these previous levels yet. So there's a bit of a negative divergence, but still this chart is really improving. Point and figure. When we look at this and we see new X's, this is a daily point and figure chart. Now, point and figure charts don't take time into account or volume. It's just price movement, and it's a predetermined amount. When we go up or down by a certain amount, an X or an O is drawn, and it could take an hour or it could take a year or 10 years, however long. Well, when we see a new green X here, and that's positive, and we were really advancing up out of this. And this was enough to generate a signal called a low pole reversal. This is the pole going down, and now with the X's going up, this is turning back more positive. And these blue lines down here, when they're going up and slanting like they are, that's also positive longer term. Just to give you a little bit of a comparison, this is the weekly point and figure chart. And we had a whole slew of green X's drawn in this past week, showing a lot of improvement here. Not enough to generate a signal, but this is really showing some improvement. So we're seeing confirmation between the daily and weekly point and figure charts. And we look at the ratio between the S&P 500 and utilities. When this is going up, that means the S&P is outperforming. Well, it had really started to go down, but since then it's starting to turn and go back up. And if we can keep going up with this, that would be more positive. And then we look at the 2-year Treasury yield. Now, this is where we kind of have to interpret what's going on in the market. We have to look at the context. For most of 2024, the context was, okay, the Fed's going to cut rates, and they had 9 rate cuts planned at the beginning of the year. Then it looked like it was going to be May and then July, and then it keeps getting pushed back. Well, now it's pretty much 100% probability that a rate cut's going to happen in September. But then at the beginning of August, when we had the employment situation report come out that was much weaker than expected, it's been a strong employment situation that has allowed the Fed to keep rates higher for longer. When that report came in weaker than expected, it freaked everybody out. There were people that's supposed to know what they're talking about, but are really just trying to feed into people's fears and emotions. We're on the financial media and probably the regular media too, and saying we need an emergency rate cut. The Fed's asleep at the switch. They should have cut rates by now. There should be another cut at the September 18th meeting. Well, that just kind of went away. When everybody's talking about it and everybody's emotional about it, and they're just throwing you fear headlines, whether it's the financial media or the regular news media, you can pretty much figure that's going to go away pretty soon because they're trying to get you to watch their channel. I don't watch the financial media myself. I think it's a complete waste of time. I'll tune in maybe to a live broadcast on YouTube when a big economic report's coming out, like CPI or the employment report, or the Fed's going to make an announcement. But a lot of times I'll just turn down the sound and I just look to see what's actually happening, and then they print the headlines on the screen. But anyway, why am I saying that for this chart? Now, usually in the environment that we've been in, when this spikes up with the 2-year yield and then starts to come down, that can give good short to intermediate term support to stocks. All right. Well, that's the scenario we were dealing with. But then when that employment situation report came out, we really started to see this fall, and we saw the S&P falling at the same time. The whole context of the reason for this falling had suddenly shifted from looking more positive to negative. Well, now that we had retail sales come out, that we had another week of jobless claims that looked pretty healthy. We had CPI, PPI, inflation seems to be under control. We're not seeing the economy falling off a cliff. Now we're switching back to the original positive scenario that the market had adopted earlier on, that they adopted for about a week and a half, the more negative scenario. So now with this coming down, this could end up giving more support to the S&P 500. All right. Then we look at another ratio between staples. These are toilet paper, toothpaste, things that you have to have no matter what's going on in the economy. When they are outperforming, that means the market's getting more defensive. When this is going down, that means that staples are underperforming the S&P, and that's what we want to see if we're more positive on the S&P. We had been really starting to go up as that fear scenario was taking over. Now it's starting to come back down. If this can continue to fall, that will be even more positive for the S&P. And then now looking more at the broader market here on top, I have two things that are measured here. This is the new highs and new lows measurement on a day-by-day basis for the S&P 500, and we're above zero, so that's positive. Then down below, this is a 50-period moving average of the daily score. That's the red line that you see in here, but it's really hard to read, so then I broke it out down here below. Now, this is still falling overall, but if this can turn and start to go back up with more conviction, that would be much more positive for the S&P. And we look at the cumulative advanced decline line for the NYSE. It fell below its moving average, but improving. Now, another thing, even when we were declining with the regular NYSE advanced decline line, we did not fall down below the moving average, and the moving average is still going up. The broader market held up quite well during that decline. Here's another advanced decline line for the NYSE that's calculated in a slightly different way. We're still above an advancing moving average and breaking out here to highs with this measurement that we use. So this is actually looking quite positive. And we look at common stock based on price for the NYSE, not breaking out to highs, but really improving here. Also based on volume, showing a lot of improvement, but not breaking out to highs at least yet. Then we look at the advanced decline line, and we have a number of different indexes. Just looking at all of these across the different indexes that are followed, the line in the sand is when we're above or below the moving average. So the NYSE common stock, the S&P, the mid caps, and the small caps, all holding up fairly well right now on an advanced decline line basis. Then here's another way to measure this. We take the NYSE advanced decline line that's on one scale and the S&P 500 that's on a different scale. But you notice when the red line's above the bar chart, that's when we tend to do really well with the S&P. When it drops below, we often see more sideways action or even declining action. Well, even as we were going down with the S&P, the broader market was holding up a little bit better. It was coming down too, but it was still above the bar chart. And now that we're going back up, we are seeing the red line above the bar chart here, and that is more positive. Then the McClellan oscillator. We did look at a McClellan oscillator for the S&P 500. This is for the NYSE, a broader measurement here. We're above zero and going up. That's positive. So we break that out for the summation index. We're going up based on price and volume. This is confirming each other and looking more positive here as well. And then we look at the equal weight, because there's the S&P 500, which is a weighted index, where you have the big monster mega caps. They account for most of the movement and most of the weight in the S&P 500. Well, then somebody decided, let's take all those 503 stocks and treat them all the same, and then compare them with each other. This is also similar in that they're on different scales, but when the red line is above the bar chart, that is more positive. That's just meaning that the stocks inside the S&P are actually holding up just as well, if not a little bit better, than the S&P 500 itself. Here's another way of measuring that. We do a ratio between the S&P 500 weighted index and the equal weight. When this is going up, that's when the big mega caps were really marching things higher. Then they started to be under pressure and we declined. Now this is starting to go back up. Comes down a little bit on Friday, but if this can continue to go up, that would be more positive and help the S&P to actually move higher. There's another way of looking at that. We look at the equal weight and compare it to the S&P, but then we flip it around. And when this is going down, that means the equal weight is underperforming. When this is going up, the equal weight is outperforming. It is starting to come back down a little bit here. It's the bigger stocks that are really going to help the S&P go up. And so we want to see this ratio continue to decline if we want the S&P to continue to advance. All right, the Dow. This is looking more positive now. We finally were able to get above its 50-day moving average, above this S1 pivot point, and get above this pivot point right here. And this is monthly. So for the month now, the Dow is looking more positive. This is like above this, we're positive for the month. Below this, we're negative for the month. And so now we're turning more positive with the Dow, even though we still have a ways to go to get back to the all-time high. The NASDAQ also was able to get back above its 50-day moving average, but it's still below this pivot point. It's still slightly negative on the month so far. NASDAQ 100 right up to its pivot point. This is what I'm going to be watching pretty close here. Can we break above this pivot point, or is this going to provide overhead resistance? Also, we were able to get slightly above the 50-day moving average, which is turning this index more positive as well. And we watch the NASDAQ 100 because the stocks in the NASDAQ 100 are also in the S&P 500. So if both are doing well, then that helps the S&P and the whole stock market to look better at the same time. And we're turning back and looking more positive here with the momentum of the NASDAQ 100. We were going down something fierce. We actually got to an extreme negative reading, the lowest reading that we see on this particular chart. We turned back up, crossed above the moving average. So we're showing a lot of improvement here. We won't go full-blown positive until we cross above zero, but this is taken as positive for right now. And then we look at the QQQs, which had fallen down, and we saw the 20 period cross below the 50 period moving average. We came down, actually opened on that big down date. We opened below the 200-day moving average. That was kind of scary, but we were able to get back and close above that. So this support level held. And then we've been going up since then. We got back above the 50. Now we're back above the 20 because it crossed below the 50. And now we're getting back above the 50 period moving average. If we can continue to go up, see this blue line turn and start to go up and eventually cross like we saw back in April and into May, that would turn things more positive for the QQQs, which is the ETF for the NASDAQ 100. Then here's a weekly chart of the QQQs, and I was pointing this out. When we were going up here, we saw a little doji thing here, and then boom, after that was when we saw the decline. Now, before you think I'm a genius at reading charts, we did see other dojis along the way, but we still kept going up anyway. When we see these things, we just notice them, but we don't really take it real dogmatic as to what's actually going to happen. It's just with this third one here that we see, this did end up leading to a decline. Now, that was really negative, and that's why we see the red candles. Well, we were able to bounce up from the low that we set on August 5th and had another solid week of upward movement here. So this is looking much better on a weekly chart. Small caps, well, people were falling in love and they were just going all up like crazy. Still haven't broken out of this bigger, longer term range here. We came down to the 200-day moving average, and I actually kind of joked about this at the time. It's like, you mean the small caps are providing support for the market? They haven't really been doing anything for the market. Well, so far, this 200-day moving average did hold on that big down day. We've been going back up, chopping sideways above the 50-day moving average. We still haven't come back to these recent highs here, but this is looking a lot better right now. Now, this is the S&P 600. We also look at the Russell 2000 small cap index. We're crossing back above 50 with the RSI. We're above the 50-day moving average based on price. Momentum is negative, but we're trying to turn up, but we haven't quite crossed over positive yet. So the small caps are showing some improvement. The big thing with the small caps is follow through, because they start breaking out here, looking really good. Everybody falls in love with them, and then boom, they go down. And then they look a little bit better, and then they go down, and then they go sideways. And then they break out, and then they go down. They've been a real roller coaster ride for a lot of folks. And if interest rates can continue to fall, that will help the small caps because they have to borrow a lot of money. And when they have to borrow at higher interest rates, that bites into their earnings. And a lot of these small cap companies don't even have any earnings. They're pretty much living off of borrowed money right now. And so if they're ever going to get to the point where they start seeing profits, they need interest rates to be lower. That's one thing that will move in their direction. And if interest rates do go down, we should see the small caps continue to improve. If we don't, then small caps may remain under pressure. Then we do a ratio between the small caps and the tech sector. The tech sector has been the darling. Well, it looked like the small caps were starting to become a darling. Well, when this is going down over the last many years here, even though it bounced back up in 2020 and 2021, that's because the interest rates were at zero at that point. And then when they started raising rates again, that's when the small caps continued to underperform. And the tech sector was doing better because these are bigger companies. Yeah, they borrow money too, but they can usually absorb that a little bit better and it doesn't bite into their earnings as much. Well, then we saw some love coming back into the small caps only to have it go away. If we want to be more positive, we will probably see this ratio continue to decline. Now, small caps can still go up even when this ratio is going down. This just means that the tech sector is outperforming small caps. Then we look at the Wilshire 5000. One of the many broad market measures that I look at, we never got down to the 200-day moving average, but we were able to get back above the 50-period moving average here, and we're in a longer-term uptrend with the blue line above the red line. So this is quite positive. And then this is the biggest ETF that I could find with the most number of stocks in it. We had come down below the 50-day moving average. Now we were able to get back above it. So this is turning the broader market more positive again. Then we look at another broad market measure, the Amex, NASDAQ, and NYSE, and take a 5-period moving average of the highs minus the lows. We had dropped below zero. Now we're starting to come back above zero and see positive readings for this indicator. Financial sector. We want the financial sector to hang in there and do well if the rest of the market is also to perform well. We were able to get back above the 50-day moving average, and we're in a longer-term uptrend here. We look at the staples to tech ratio. When this is going down, that means tech is outperforming. When this is going up, staples are outperforming. This is when the market was becoming more defensive. Now we're starting to see this ratio come down. To be more positive on the market, we want to see this ratio continue to decline. The FANG index, which was another area I was watching on the big down day, we came down to the 200-day moving average and bounced up off of that. So we saw it with the small caps. We were hitting intraday support on the S&P 500, and we hit the 200-day moving average with the FANG index all at the same time. So this was building pretty good support at that time. And we bounced up off of that, and we were able to close just a little bit above the 50-day moving average. We were a tick above on Thursday. We closed a little bit higher on Friday. So this is showing a lot of improvement. Then these are some trend lines that I drew on here. As we were going down, we broke below this shorter term trend line and then a longer term trend line. Well, we were able to recapture both of these trend lines as the FANG index has been going back up. This is a weekly chart of the S&P, and I've been talking about this chart, it seems like all of 2024. We finally were able to break above R1, and then we started to go up to R2 and broke above that. Well, this was another on a weekly chart. This was almost near the low that we set on August 5th. This is another chart I was watching that day. Adding more to the support was being built, and we were able to bounce up out of that, and we were able to bounce up again this week and then close above this R2 level. So we have two solid up weeks here with the weekly chart of the S&P 500. Now, we're not reaching all-time highs yet, but this is really showing an awful lot of improvement. Then we look at a weekly chart here. This is a trend line going back to the 1987 crash. Even with the decline, we're still above that trend line. This is that same chart, but just going back to 2018, where we're still far away from this trend line. Then we look at another ratio between the NASDAQ 100 and the Dow. And I actually got the idea for this from a perma bear. And they thought, okay, here we come up here. And then we came up here in 2021. Ooh, we're coming up here. This is the holy grail, baby. The market's going to come back up here, turn and go down. Well, we actually broke above it. And even when we were declining, we never got down to this red line. And now this is starting to go back up. So the perma bears aren't quite dancing as joyously as they were just a week and a half to 2 weeks ago. Here's another ratio that they thought was certainly going to mean the end of the stock market as we know it. These are the Qs, which is the NASDAQ 100 to the small cap ratio. Well, when we came up to this blue line, which is what we set back in 2000, they thought, okay, we're going to hit this turn and just go in the toilet. Well, we ended up breaking above it, and then we fell down below it, but now we're starting to break it above it again. So that's why I don't listen to perma bears. But sometimes they're so negative, no matter what information, evidence that you throw at them, they can still come up with, okay, everything's going to fall apart right after this. And but some of their charts are kind of unique, and so I've adopted them over the years and follow along with them. But I try to treat them more objectively than just saying it's predicting doom and gloom. What an awful way to live. Anyway, we look at another ratio between the semiconductors, a huge part of the tech sector, and the Dow, which is more value here. And the semiconductors were really outperforming, went above this blue line, set back in 2000 again. We started to come down. It was showing some weakness as we were seeing weakness in semiconductors, but now it's starting to go back up and showing some improvement here. A weekly chart of the NASDAQ 100, we broke below the trend line going back to 2009. We've been able to get back above it now. And then this is where we look at, okay, are we going to have a soft landing, meaning no recession, or a hard landing, meaning recession? Well, for most of 2024, we've been above this rainbow and going up. There are periods of weakness along the way. Well, then when everything started to shift over and look more negative, that's when we started to really come down inside the rainbow. We finally bottomed here. Now we're starting to go back up as they're adopting more of this soft landing scenario. And this is showing some improvement, but we're still not quite out of the upper side of the rainbow yet. We look at the QQQs and compare it to 3 to 7 year bonds. Came all the way down to the 250-day moving average and then bounced up off of that, but still needs to come up out of the rainbow to turn even more positive. Home construction, very interest rate sensitive, was really doing well, came all the way down to the 250-day moving average, bounced up off of that, was looking a lot better, and then went down with everything else. This is now starting to turn back up, so it's showing some improvement here. The S&P 1500, which is a broad market measure compared to short-term 1 to 3 year bonds, this is actually starting to break out above the rainbow again, meaning the stocks are outperforming short-term bonds. This is another broad market measure with 3 to 7 year bonds, a little further out, starting to come up into the high end of the rainbow here. The tech sector to 3 to 7 year bonds coming back up into the rainbow, but still not peaking out, at least yet. The Eurozone, where, yeah, I know this isn't apples to apples. This is apples to oranges here, where we have European stocks compared with American bonds. We actually broke below the rainbow here with this ratio, but now we're starting to show some improvement. We want to keep an eye on other markets, especially Europe, because we're closely tied to each other. And with this whole global economy that we live in now, we want to pay attention to what goes on in Japan and in Europe. And China's really big, but not really influential yet from a stock market perspective. All right, then the 10-year yield, this had been starting to go back up. This is on the positive side because we are overall continuing to decline. We're also in a downtrend, and that's more positive for stocks when interest rates are going down. We also do another comparison from 3 to 7 year bonds to stocks. When this is going down, that means bonds are underperforming. Well, they really started to kick into gear here as that scenario was changing. Then the scenario switched back to positive, and now it's starting to come down again. And we look at 1 to 3 year bonds, compare them with 3 to 7 year bonds. Now, we also have to know the context. We want this to decline. But when this was really screaming to the downside, it was declining out of fear that we're going into a recession, not because the Fed is going to come in and raise interest rates to try to tweak the economy. Well, then the market kind of, okay, maybe things are a little bit more positive. We're still declining overall, but we have to look at the context as to why is this ratio actually going down. It had been positive as we were chopping our way lower here. Then it turned to full-blown negative. Now we're switching back more to positive. And you'll see that a lot in these charts. The same thing is true with this. Tips, Treasury inflation protected securities. When this is going up, the market's worried about inflation and interest rates. When this is going down, that means inflation is going down and interest rates are going down. Well, why are they going down? When this is rolling over, it's because, well, we're seeing a little bit of economic weakness. Inflation is getting closer to that 2%. And then it just fell off a cliff as the market developed a fear type of approach to the market. And now it's kind of settling down here just a little bit. So we want this to decline, but we want to know why it's declining. The same thing is true here. When we look at riskier bonds like junk bonds and more conservative bonds, this had been falling off as folks were thinking, uh-oh, we're going into a recession. We better get out of these risky junk bonds and get into more conservative government bonds where we can lock in a higher yield for a longer period of time. And that's what we saw happening here. Well, we're seeing this start to kind of gather itself together as well. And we want to keep an eye on the dollar. It's still in an uptrend. We've actually switched over on the weekly chart to a negative trend. We haven't seen the purple or blue, whatever color moving average this is, cross below the orange moving average. But this has been showing some weakness, and the market likes that. That's why this is on the positive side, since the market likes a weaker dollar. That's for, it looks better on the books. The conversion rates are more friendly. The import-export relationships are more friendly. So they like the dollar when it's weaker. All right, now we have the negative side, and the positive side was pretty long. Now, a week ago when I did this video, the negative side was really long, and we had an up week. So we'll have to see if this actually ends up meaning anything. We're not looking all that great here with our intraday large cap growth versus large cap value. Now we're improving. Both the red line and the blue line are going up, but we want to see the blue line above the red line. That means growth is outperforming value. And even though they're both going up for now, we're not seeing the blue line above. That would turn things more positive. And we're going up a little bit here with small cap growth to value. Now, these are end of day charts, but not really breaking out right now. We need to see more improvement here. And similar, we're going back up with mid caps, but no real strength right now. S&P growth to value. We were looking a little bit better, but now we've just kind of fizzled out. We want this to really go up to help the S&P justify going higher. That means growth is outperforming value. Here's some other growth to value ratios showing a little bit of improvement here with the Qs to S&P above the moving average, but the moving average is still declining. We're coming up to a declining moving average when we look at discretionary to the S&P and a little bit above the moving average when we compare large cap growth to large cap value. We want to see all of these going up, and we want to see the moving averages going up to be more positive with these ratios. So we're looking a little bit better with the large caps, a little bit of an improvement here with the mid caps, and we're kind of chopping sideways a little bit above the moving average with the small caps. Again, we want to see all of these going up and seeing the moving average turning up as well. Discretionary to staples, not really helping things right now. We want this to outperform and see this ratio really going up, meaning discretionary is doing better than staples. Well, it's really not right now. It's improving, but it hasn't really shown any strength yet. And then this is, we were positive, extreme positive for most of 2024. And then we saw the downward move in April, and then we were able to get back up here. We're still down, even though we're bouncing back up. Now, this is longer term. It's a 10-day average of the highs minus the lows for the S&P. If this continues to go up, this will look more positive. So this is improving, but the fact that we were really, really positive and dropped down, that's why this is on the negative side of things. This is the 50-period moving average of the new highs, new lows for the S&P. I showed a different version of this chart earlier where it's declining. If we can see this turn and go back up, that would be more positive. And the Ichimoku cloud. Now, this is positive in that we're coming back up through the cloud and we're above it right now. But the red line's still above the blue line. But the blue line's starting to come up. And so if the blue line crosses above the red line, that would turn this chart positive. Also, there's a green line in here that's probably pretty hard to see. That's also been improving lately. So this chart is improving, but until we cross above the red line, it's still considered to be negative. This is a concern. As we're coming down, we saw volume just really going up. This is a volume oscillator. And now, as we've been going up, we're seeing volume really dropping off. And that's a classic negative divergence and something we want to be aware of. Now, it is the summer months and people are on vacation, blah, 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 blah. But this is something that we're just keeping an eye on right now. To see price going up as volume goes down doesn't give us an awful lot of confidence, but we ultimately have to rely on price. The mass index, there's three parts to this signal here. And two of them have been triggered. The first part was when we went above the red dash line. Part two was when we went above the blue line. We're starting to roll over, but when we finally come down and hit this red dash line again, That's the third signal. And whatever the market was doing at that time, if it was going up, the mass index is suggesting it's going to reverse and go down. If we were going down, it's going to reverse and suggest that we're going to go up. Now, this has far from a perfect track record here. That's why we don't use this in isolation. We don't make decisions based on just this chart, but we look at this when this is finally triggered, because it'll come down at some point. What is happening and what are we seeing in other charts at that same time to try to give it some context? And then we're looking at this. It's showing an improvement, but still a little bit scary. This is the spread between risky and not as risky bonds. And this is a longer term chart and it's hard to see. Now, what happened here is this is inverting things to line up more with the S&P 500. When this is going up, that means things are improving and fear is going down. And that's what we want to see if we're going to turn more positive on the S&P. We want this to continue to improve. And it's still giving us a pretty high reading here. And this really going down was causing some concern. This is while the market was adopting that doom and gloom scenario. And then I also invert the VIX here as well. And it just went all over the place crazy. Just want to keep an eye on this. And the small caps to S&P 500 ratio, we were seeing small caps in the early part of July really starting to outperform. Now they're starting to come back down. Mid caps, not really showing an awful lot of strength. If you go back earlier in 2024, the mid caps were one of the best performing indexes. Not right now. We were able to get above the 50-day moving average, but we're still below this midpoint. And we spent an awful lot of the summer chopping sideways here. Then we chopped sideways a little bit higher. Then we fell. We are improving. All right, but we still have some overhead resistance to get through. And then this is something, and I'm not sure if it's positive or negative. On top is the S&P 500, which has been going up. We have the home builders ETF, which has been going up, but not as much. And then we look at the bottom here. This is the correlation between the two. And we're seeing that they're going in opposite directions right now. And we don't know, is this negative correlation, is that going to pull the S&P down? Or is this negative correlation going to pull the home builders ETF up? That's why I'm not quite sure if this is positive or negative. We just want to watch this and see how it plays out. And we keep an eye on the yield curve, getting really close with the 10 to the 2-year, going back to being normal, but we're not there yet. The two main yield curves that we follow are the 10 to the 2-year on top and the 10 to the 3-month. I have a few other ones plotted on here, but they're really not treated with all that much importance. This is a breakout of the 10 to the 2-year. Notice how we got really, really close to coming back to being normal again, but we're not there yet. You also want to keep an eye on the 3-month yield. When this is starting to roll over and go down, that was causing us some concern. Why is it going down? This is because the market was starting to adopt a doom and gloom type of scenario, because that's what happened back in 2007 and into 2008. And we saw the whole great financial crisis after that. So now it looks like things are settling down a little bit. If we could get back up and then go sideways, that would mean that things are a little bit better under control. We want to keep an eye on oil, mainly for geopolitical reasons. We continue to drop, even though there's this threat of Iran going to war against Israel directly, and even the word nuclear has gone back and forth a bit there. We're in the mid-70s, where we had been above into the low 80s now. But if this spikes up because things are really escalating in the Middle East, that's geopolitical, and that could have a negative impact on stocks. Now, as I usually explain, there's been other times when oil's been going up, and that's because the companies are earning more money and people want to buy the stock and things are looking better for those companies. Yeah, oil can go up with the stock market, but when it's a geopolitical event that affects oil, that can be more negative. And we also want to keep an eye on utilities. They're really breaking out, doing good here. But this is usually a more defensive type of area of the market. Now, you can make a growth case for this because we have AI, we have all the Bitcoin mining, we have all these EVs out there. And so this could suggest higher prices for utilities more from a growth perspective. But usually when this goes up, it's more of a defensive perspective. So we don't really know. We were looking at both sides right now, and we've been just keeping an eye on this. When we compare the utilities to the S&P, they had been really underperforming. And then in July, boom, they really started to outperform. And now, after we finally bottomed here in the early part of August, this is starting to come down again. Another defensive sector that we follow are staples. When you look at this all by itself, it's in a solid uptrend, barely even came back down to its 50-day moving average when it pulled back. But when you compare it to the S&P, it was starting to really break out to the upside. Now it's starting to fall back as we're adopting more of that positive scenario. Another defensive area, healthcare, looking really good all by itself, well above its 50-day period, 50-day moving average, and looking pretty solid right now. But when you compare it to the S&P, really underperforming, starting to break out to the upside, now also starting to come back. Then the parabolic SAR weekly chart, where we turn positive on the daily chart, we are negative with the dots on top here with the weekly chart. So thank you. I really hope you found this helpful. If you want to hear about updates, and if you want early access to the daily videos and also the weekly videos, please, for free still, look at joining up on the SPX Investing Program website. And right as soon as I prepare the videos, members have access to that, where there's a considerable delay if you're not a member before they go public on YouTube and on Rumble. So I hope you're having a wonderful weekend, and I will talk to you in the next video.